There's Caleb. He's a farmer in this video and he's picked some carrots for his granny. In this video I'm going to cover who must register for VAT, VAT categories, the VAT Control account. I will look at Input and Output VAT. I will look at and compare the invoice versus the payment basis on recording VAT, and I will introduce the different levels of production. What I've got here is the first level of production. I'm looking at farming, so I've got a few pictures of Caleb's little farm at home, and there's Mommy and Caleb at a strawberry farm, and we had something to eat at the strawberry farm. But VAT is introduced right at the first level of production, farming. On this slide, I will look at who must register for VAT, and then some facts and figures with regard to VAT. There are two types of registration for VAT: compulsory registration, and then you can voluntary register your business for VAT. I'm looking at this video in a South African context, so I'm using rands, but the same principles of VAT will apply in all countries. But in South Africa, if the annual turnover, the annual sales of taxable supplies, standard rated supplies, we'll have a look what is a standard rated supply. But if the annual sales is over 1 million rand, it is compulsory to register for VAT. If the annual sales, the yearly sales of standard rated supplies is between 50,000 rand and 1 million, registration is voluntary. So if sales is over 1 million, it is compulsory to register your business for VAT. You can register for VAT if sales is between 50 and 1 million rand. A VAT return is done on or before the 25th of every second month. Just an interesting fact: if the sales is above 30 million, a VAT return must be completed on a monthly basis. But this year is the norm. Every second month on the 25th or before the 25th, a return will be submitted to the South African Revenue Services. Just points to note: if you want to be able to claim VAT, the person that you're dealing with, the person that is supplying to you, must be a registered VAT vendor if you want to claim input VAT. More about what input VAT is to follow. And obviously the documentation must be correct. You need to receive a valid tax invoice from the supplier. So you can only claim input VAT if the supplier is a registered VAT vendor and you receive documentation that meets the criteria of revenue services. We get 4 different categories, different VAT categories, and I will point them all out to you. But there's a category where 15% can get claimed. Then there are 3 categories where there is 0% VAT. Oh, I see VAT Boy has popped in to just take a look. and I can see he's quite happy. You get standard rated items. So the first VAT category is standard rated items. Now there's the definition of a standard rated item: an item on which input VAT can be claimed. So these items that are purchased for a business, say for example equipment or stationery, 15% you can claim if you're buying from a VAT vendor on standard rated items. So if we bought equipment for 115 Rand, 15 Rand could be claimed for input VAT. There are certain items, they are called zero rated items, where 0% VAT is applied. 0% VAT, there is no VAT on zero rated items. And the purpose of this is to alleviate poverty and also to make exports less costly. There are exempt supplies, and once again, no VAT can be claimed on 0% VAT. We will have a look at examples of exempt supplies in the next slide. And then there are non-allowable items. So when certain items are purchased, no VAT can be claimed. For example, items that are going to be used for the staff. Most of the time when we get onto journals, we will deal with standard rated items. So all goods, services, products that are purchased for the operations of the business, in order for a business to make a profit, 15% input VAT can be claimed. So VAT categories, there are 4: standard rated items, zero rated items, exempt items, and non-allowable. With standard rated items, 15% can be claimed. That is our VAT rate in South Africa. It can be different. It just depends on the government, revenue services, to determine the rate of VAT. What is the difference? Very important, maybe for a short question. What is the difference between zero rated vendors and exempt vendors? We know that both categories 0% VAT is applied. Let's see what the difference is. Registered zero rated vendors can claim input VAT. Then the vendors of exempt suppliers may not register for VAT at all. So those people selling exempt supplies may not register for VAT at all. Therefore, obviously, no VAT can be claimed. So there you can see the difference between zero rated vendors and exempt vendors. Zero rated vendors can claim input VAT, and exempt vendors may not even register for VAT. So therefore, they can't claim VAT. Here are some examples of standard rated supplies, zero rated supplies, exempt supplies, and non-allowable items. Our 4 categories of VAT. Remember, standard rated items, 15% VAT can be claimed. 0 rated items, 0% VAT. And I'm stressing this all the time because in an exam, some people, lots of people, go and calculate 15% on 0 rated items, exempt supplies, and non-allowable items. These three categories, 0 rated, exempt supplies, and non-allowable items, there is 0% VAT. You only calculate VAT, input VAT and output VAT on standard rated items. And there, standard rated items in our country, the rate is 15%. Here are examples of standard rated items. Any item that is used in the business to generate a profit. So stationery, I've put here equipment, and in brackets I said a kettle for the business. So if you have a restaurant, the kettle would be part of the equipment of the business. But if the kettle were for the use of the staff, that item would be non-allowable. Anything that is used for the staff, it falls under non-allowable, and there will be 0% VAT. Right, furniture, trading inventory, telephone, water and electricity bill, they're all necessary for the running of the business. If you were a doctor and you subscribed to the medical council, you are able to claim 15% VAT because it's necessary for a doctor to stay up to date. So the item is standard rated. A delivery vehicle is a standard rated item, but not if the delivery vehicle is for passengers. You can, if the nature of your business is to pick up clients from the airport, for example, you can apply to SARS to have the vehicle, to get permission to claim input VAT. But generally speaking, a passenger vehicle is not a standard rated item, but a delivery vehicle is. Right, white bread. If white bread was purchased for the sale of sandwiches, you make sandwiches, white bread would be stock, as opposed to brown bread, which is 0 rated, because 0 rated items are there to alleviate poverty. Brown bread is seen as an item which alleviates poverty, and it is 0 rated. Right, the electricity portion of rates and taxes bill, standard rated. You got diesel and petrol, 0 rated. Paraffin, brown bread, 0 rated. Fruit, vegetables. Exports. You can go through this list. It's not finite. There are lots of other items, but you will get an idea. Exempt supplies include interest, like interest on a fixed deposit, interest on a loan, life cover, life assurance, rent for private residence, exempt as well, transport by bus, train or taxi, exempt from VAT, donated goods sold by non-profit organizations. This will pop up later when we do some journals. The rates portion of rates and taxes bill is exempt, and it will affect our calculation. when we calculate VAT. Here are non-allowable items. I have discussed briefly passenger vehicles and the kettle for staff use. A double cab or twin cab vehicle is non-allowable. It's seen as a family car and not a delivery vehicle. So be careful when you buy a vehicle and you want to claim VAT, you need to check where you can claim input VAT. If you have a business that makes digital products and you buy a gym subscription, you can't go and claim input VAT. White bread for staff lunches, anything that is for the staff, 9 times out of 10, maybe 10 out of 10, it will fall under non-allowable. So this table here has given you examples of standard rated items, zero rated items, exempt supplies, and non-allowable items. Standard rated items, you can claim 15%. Zero rated, 0% VAT. Exempt, 0% VAT. And non-allowable items, 0% VAT. A possible test question could be complete this table and you're given these items and you'd have to determine what category they belong in. You're given the amount of each item excluding VAT. Right, no VAT is on the amounts in this column. You need to calculate the VAT amount and then the amount including VAT. But the first thing you need to do is to slot these items or identify or recognize which VAT category these items fall into. So if we take stationery, you've learnt your table and all your items of the different VAT categories. Stationery is used in the operations of a business in order to make a profit. Stationery fits the definition of a standard rated item. The amount, the cost of the stationery is 127. Now the VAT amount, remember the VAT amount of a standard rated item is 15%. The standard rated item stationery, when it costs 127 excluding VAT, the VAT amount will be calculated as follows. We say 127 times by 15% is equal to 16 Rand 57. So there we have the VAT amount. Now obviously if I want the amount including VAT, it's 127. That's the amount excluding VAT, plus the VAT amount which we just calculated, will give me the amount of stationery, the item, including VAT. And as I mentioned, there is the calculation. The amount, 127 excluding VAT, plus the VAT amount is equal to the VAT inclusive amount of 143.57. So there we go. If I want to calculate the VAT amount, I take the amount excluding VAT and I multiply it by 15%. I will do a whole video on VAT calculations. It will be the next one in this series. But here in this table, I'm basically just looking at identifying the different categories of the items that are given. So staff kettle, we've learnt anything for the staff is non-allowable. now. Very important. If something is exempt, non-allowable, or zero rated, the amount of VAT is zero. And what happens, as I mentioned before, some people will still go and calculate the VAT on the 210, even though you have got the correct category. The amount of the VAT, whoop, VAT boy's coming to check up. He's popped in. Right, interest is exempt. Bananas, zero rated. So now you've classified all these items into their correct categories. You've calculated the VAT on stationery and the VAT inclusive amount. Non-allowable items, the VAT is zero. So 210 plus naught. Let me just complete these three categories here. All these three items, there is 0% VAT. And the totals, therefore, 210 plus naught is 210. 106 plus naught is 106. 53 plus naught is 53. So in this example here, there was only one calculation where you calculated the VAT 15% of 127 and you got the VAT inclusive amount by adding the exclusive amount plus the VAT amount gives the inclusive amount. And these three items, there was 0% VAT, so the totals remain the same. I put this in here just to point out, over here, a careless error can take place when 15% is calculated on non-allowable, exempt and zero rated. Their VAT rate is 0%, 0%, 0%. Don't make that mistake if you're given a question like this. This slide is going to get quite busy, so you're going to have to pay careful attention. If you look at the top, what is input VAT? Input VAT is 15% of standard rated items purchased. So we can claim 15% on an item that is used for our business in operations in order to generate a profit. What is output VAT? Output VAT is 15% on which we add to the selling price, which first of all is excluding VAT. We add 15% to the selling price and we charge our clients an extra 15%, and that money we collect on behalf of our revenue services. So I'm going to look at two transactions to demonstrate input and output VAT. The first transaction, we bought stock as per invoice from a VAT vendor, so we can claim input VAT. We paid cash and the amount was 7,475. Now we need to record that transaction and we need to identify the accounts involved and we need to apply our rules. You need to go purchase my video on the rules if you haven't seen it. It's quite comprehensive and you'll be able to apply the rules. So the first account, because this is a cash transaction, the first account is bank. And bank here is a liability, you will see, because we're in overdraft. It has a credit balance according to our books. So bank gets credited. This full amount is paid for stock, 7,475. So we pay the supplier 7,475, and this account gets credited. This can actually be, if bank was an asset and we did have money in the bank account, our current account, a decrease in assets, the account gets credited. But because this bank account in our books has a credit balance, it's a liability. The next account, which is an asset, and it's the first time you're hearing this, input VAT is an asset. The asset gets debited because we can claim 975 of the 7,475 because stock is a standard rated item. So we can claim input VAT, and I will show you how to calculate that 975 towards the end of the slide, and in the calculations I will show you how to calculate all VAT amounts. Trading inventory was purchased, and trading inventory is an asset. When we purchase stock, the value of our asset, trading inventory on hand, increased, and the rule says we must debit trading inventory. And the amount is excluding VAT. The 6,500 is the historical cost price of the stock, which excludes VAT. And by the way, you can see here the debits equal the credits, with 975 plus 6,500, the two debit entries, it's equal to the credit entry of 7,475. So this is how input VAT is arrived or derived. We take that amount and we multiply by the VAT fraction, 15 over 115, more about that in a short while, and we will get 975. So from this transaction, the input VAT that we can claim is 975. Now the next transaction, we're going to sell the stock on credit for 10,925. This amount, the selling price, includes VAT. So the first account is sales. Now we are going to collect output VAT, which is a liability, by the way, because the amount of money, the 15% that we collect on the sales, is owed to the revenue services. It's a liability. And we sold this on credit. So we now will have debtors control, another account. So when we sell the stock, I'm only doing the sales part of the entry. We have debtors control, sales, and output VAT. Debtors control is debited with the full amount, including VAT, because we're going to get this money from the debtors at a future date. Sales is the amount after the VAT has been taken off, and we multiply by 15 over 115. to get the VAT amount of 9,500. I'm going through this quite quickly, but don't stress. I'm going to have a whole section on these calculations. And output VAT, which is a liability, is credited with the VAT amount. So here we had the purchase of stock and the sale of the stock. We could claim input VAT, and we need to collect output VAT on behalf of SARS when we make the sale. This amount here, the sales amount, excludes VAT. This here, I have briefly mentioned it, is the VAT fraction. We are going to be using this fraction plenty. So I thought I would introduce it just so we get your mind thinking about it. But the top above the division line is the numerator, which is 15, which is the VAT rate. The denominator below the division line is 115, which is 100 plus the VAT rate. So if the VAT was 10%, it would be 10 over 110. But it is 15%. I'm working on 15% in my examples because that's what it is here in the country. So the VAT fraction is 15 over 115. And we're going to use this fraction plenty in order to calculate the VAT amount. So on this slide, I've introduced input VAT, the amount of money we can claim on standard rated items when we make a purchase. And I've introduced output VAT. When we make a sale, we're going to add 15% to our selling price, and we're going to collect that 15% on behalf of SARS. Then what we're going to do is we're going to do a VAT return also in one of my videos, and I will show you how to calculate what will be paid to the revenue services every couple of months depending on what you've arranged with the revenue services. Did I make a mistake, boy? Let's check what mistake I made. In the previous slide, I did actually refer to this 9,500 under sales as the VAT amount. I carelessly did that, so I'm just quickly going to point out exactly what each amount is. The transaction read, sold the above stock on credit for 10,925, including VAT. So in order to calculate the VAT amount, I say 10,925, the inclusive amount, the selling price including VAT, times by the VAT fraction, 15 over 115, and that gives me the VAT amount of 1425. So the output VAT is 1425. And in order to calculate the sales amount excluding VAT, I say 10,925. That was the selling price including VAT, less the 1425, the VAT amount which we just calculated, is equal to 9,500. So thanks, boy. I did make a mistake on the previous slide, but hopefully that clears it up. You might not even have picked up the mistake, but I did carelessly refer to that 9,500 as the VAT amount. The VAT Control account keeps a record in one account. Here we go, the VAT Control account. It keeps a record of input VAT and output VAT. I've taken screenshots from the previous slide of the input VAT that was calculated and the output VAT that was calculated. There are different ways of keeping VAT records. Some people might use an input VAT account and an output VAT account and then close off those accounts to the VAT control account, or businesses might just use one VAT control account, and on the debit side you're going to have the asset input VAT, and on the credit side you're going to have the liability output VAT. So if one account VAT control is kept for both input and output VAT, it would look like this. On the debit side we would have the input VAT, and on the credit side we would have the output VAT previously calculated. And while we're on this slide, if we balance this control account, we would actually see what amount is owed to the revenue services. If we say the output VAT less the input VAT, you will get in this case here 450, and that amount is owed to SARS. If we've calculated all the VAT for a 2-month period, we do a VAT return. This is a simple example, but it will illustrate output VAT less the input VAT will give you, in this case, 450, and that would have to be paid to the revenue services. But the purpose of this slide here is just to demonstrate the VAT control account. So in the general ledger you might have one account for VAT, and it will be the VAT control account. You may have an input account, input VAT account, or an output VAT account and close them off to the VAT control account. So there are different ways of recording VAT, but the end result is all the same. Output VAT less input VAT will give you the amount owed to SARS. What should we do now? I'm going to look at two ways to record VAT. There's the invoice basis method. Input VAT and output VAT, they're both recorded at the time the transaction takes place. So the invoice date. So if something is bought on credit or sold on credit, VAT is recorded. If an item is bought cash or sold cash, input and output VAT is recorded. So with the invoice basis, VAT is recorded at the time the transaction takes place. But with the payments, the cash basis, VAT is only recorded when payments take place. So if we paid a supplier cash, VAT would be recorded. If we sold an item on credit in the payments method, VAT would only be recorded when the cash is received. So if you start to think about it, there might be an advantage with the payments cash basis, because if you, with the invoice basis, made sales on credit, you might have a cash flow problem, because remember, you haven't received the cash yet. You might have terms with your debtors where you only receive the cash in 90 days. So when you set up VAT, you need to look at these two methods. Now in South Africa, we use the invoice basis method. But I know in other countries, they use the payments basis method. In South Africa, you can apply to the revenue services if you could possibly have a cash flow problem to use the payments basis method, where VAT is recorded only when there's a movement in the bank balance. So cash is received or cash is paid with the payments method. But by default, when you set up VAT in South Africa, the invoice basis method will be used. Just above here, I have an example of a tax invoice. Oh, and if you're getting a little bit sleepy before you fall asleep, maybe push pause, take a break. We haven't got too much further to go in this video. So on this slide, I looked at two ways to record VAT: the invoice basis method and the cash basis method. As I mentioned on the previous slide, the payments cash basis can be used if the following criteria is met. You are a sole trader or a partnership whose turnover does not exceed, that says 2.5 million. Associations not for gain and local authorities may use the payment method regardless of turnover. So associations not for gain and local authorities can use the payments method. Then this is most probably more applicable to us. Vendors who wish to use the payment method may apply to SARS, the revenue services, in writing. So if you're worried about a cash flow problem, you can apply to SARS to use the payment method. And that there is just a definition once again of the payments cash basis method of recording VAT. So VAT is only recorded, or VAT is recorded when a payment of cash or a receipt of cash takes place. So at that point, VAT is recorded. In other words, when the bank balance changes, VAT is recorded. Let me use this slide to point out a possible problem using the invoice basis method. So I'm going to look at two transactions to demonstrate this possible cash flow problem. So transaction 1, we bought stock as per cash invoice, including VAT 7475. So we bought stock inclusive of VAT, and it was 7,475. So what we need to do is record this transaction, and I've put down at the bottom here just some screenshots from a previous video, steps to deal with any given transaction, and then we got the rules. So if you've forgotten your rules, you can go watch my previous videos on the accounting rules. So in this first transaction, it was a cash transaction. So the first account we're looking at will be bank. Now I've put here that bank is a liability. We've been given an overdraft facility. At the moment, I'm just pretending, I'm using my imagination here to demonstrate this. But our bank has given us an overdraft facility, so we can spend more than what we have in our account. And at the moment there is nothing in our account. But now we've gone and used this overdraft facility and we've bought stock cash, 7,475. So our bank balance will decrease, or our liability will increase. Seeing that we owe the bank money, the liability has increased, and the rule says an increase in liabilities. You can check the rule down here. You must credit the account. So in our books, we're now sitting with 7,475 on the credit side of bank. We can claim input VAT on stock, and input VAT is an asset. If I go and multiply the 7,475 by the VAT fraction, we will get the VAT amount of 975. So input VAT is an asset. We can claim that amount back from the revenue services. An increase in assets, according to our rule, gets debited. And then trading inventory, which is also an asset. We've bought stock, and the amount excluding VAT is 6,500. The value of our asset has increased. An increase in assets, the account must get debited. So now I'm sitting with the scenario. My bank is in overdraft, 7,475 after this cash purchase. We can claim 975 input VAT after purchasing the standard rated item, trading inventory. So we can claim 15% of the 7,475. Well, we need to multiply this by the VAT fraction. Now the second transaction, we sell the stock. Let me just rub this out quickly. The stock gets sold for 10,925, including VAT, and I'm only going to do the sales part of the transaction. So we have sales. Sales is income. An increase in income, the rule says we're going to credit the account. We're going to collect output VAT on behalf of SARS, because 15% was added to the selling price. Output VAT is a liability. Debtors control is debited, because debtors control is an asset. Our debtors owe us more. An increase in assets, the account will get debited with the full amount, including VAT, 10,925. If we take off the VAT amount by multiplying this by the VAT fraction, 15 over 115, it will give us 9,500. Sales was credited as it was an increase in income, and the rule says increase in income, you must credit the account. Output VAT is credited, increase in liability. So now we are sitting with this situation. This is the situation. I've taken a screenshot from the previous slide. Bank has a credit balance. That means we're in overdraft. We owe the bank 7,475. But after those two transactions that took place, we owe 450 to SARS. There it is, 450. And how I calculated that, I said output VAT minus the input VAT. Can you see there's a problem? We haven't actually collected this money from the debtors, but now we must go and do a VAT return. We owe the bank money, and now we owe SARS money. Now this is just a tiny example of how the invoice basis method can have a negative effect on the cash flow, and you're not going to be able to make payments. So watch out for this. Hopefully I just demonstrated this cash flow problem in a simple way so you understand it a little bit better. Before I get on to calculations on VAT, I just want to show you this little equation. Cost price plus markup is equal to selling price. These amounts exclude VAT. So before VAT comes into play, I'm looking at the VAT exclusive amounts of different levels of production. Here you can see Caleb is our little farmer. At the farming level, a farmer can claim input VAT. VAT is already taking place. But with this slide, like I said, I'm going to look at the exclusive amounts. So no VAT is included here, but I'm going to show you how a markup is achieved at each level of production. So the farmer pays 10 Rand for items, standard rated items, or items to enable him or her to farm. When they sell the product, they're going to add an extra 10 Rand, so therefore the selling price will be 20. So the cost price plus the markup is equal to the selling price. When it gets to the next level of production, the selling price, when the farmer sells to the manufacturer, the selling price of the farmer becomes the cost price of the manufacturer. And in this example, there's a gross profit or markup of 10 added to the cost price of 20, which gives a selling price of 30. So the person, let's say, making the strawberry jam, the manufacturer, is going to sell to the wholesaler for 30. And likewise, the selling price of the manufacturer becomes the cost price of the wholesaler, and 10 Rand is added, and the selling price to the retailer is now 40. Remember, these numbers all exclude VAT. So the wholesaler sells to the retailer, and the cost price becomes 40, and the markup is 10. I've been consistent with the markup on each level, and the selling price to the consumer will be 50. So that is how, without VAT, items get more expensive at each level of production. Because at each level, these people are in business to make a profit, so there's a markup at each level. So what I've demonstrated here is the cost price plus the markup, which is the gross profit, is equal to the selling price, with numbers excluding VAT. In the next video, I'm going to do a whole lot of calculations where VAT is included. And be careful, because the worms will come and eat the fruits of your labor. Be careful for the worms. This was an introduction to VAT. You guys are doing really well. Keep it up. In the next video, I'm going to do some VAT calculations, and it wouldn't be right if I didn't end with my black paintbrush. So I will see you in the next video where we're going to conquer some calculations.